Let me start with something that might sound a little strange at first. Did you know that every single one of us is a lender? Whether you signed up for it or not, whether you like it or not, or whether or not you're being paid fairly for it or not. Because here's the truth. A bank's primary job is not to store your money. It's not customer service. It's not the marble floors and the fancy vaults. A bank's job is to lend money. And the most important question is, whose money are they lending? Well, it's yours. It's your checking account, your savings account, your money market, your CD. The moment you deposit money into the bank, you hand over control to the bank. And the bank then turns around and lends it to someone else. So whether you realize it or not, you are the lender. The bank is just the middleman. Banks are what we call intermediaries. Just like a real estate agent or a stockbroker, except banks sit between people who have money and people who need money. And guess who keeps most of the profits? Well, if you look at your bank statement, you'll realize it's not you. Banks want you to believe that your money's sitting safely in a vault, waiting patiently for you to need it. That's a great story, but unfortunately, it's not reality. Banks operate under fractional reserve lending as well, which means if you deposit $10,000 into the bank, they only need to keep 10% of that on hand and they lend the rest out. Or another way to look at it is they can lend up to $90,000 on the $10,000 that you put in. Your money is now in someone else's mortgage, their car loan, their student loan, their credit card. And this whole lending system works as long as everyone doesn't ask for their money back at the same time. Now, here's how banks really make their money. They make it on what is called the spread. What's the spread? Well, that's the difference between what they pay you and what they charge borrowers. So let's say they pay you 2% and they loan your money out at 8, 10, 12, 15%. Well, even at 8%, that's a 6% spread. That's 3 times the money that you're making. But here's where the real magic is. They didn't use their money. They used your money, which means their return is effectively infinite because they made a rate of return on someone else's money. And they repeat this process again and again, leveraging depositor money until returns reach 30% or even more, and they do it somewhat safely. And what do you get? Maybe a toaster. And here's the part most people never have been taught. You actually can do the same thing, but instead of using your bank, using your money, you use the bank's money. Banks love safe collateral. You see, cars depreciate, boats depreciate, toys depreciate. But one asset banks love, it's classified as a tier 1 asset, is a properly structured cash value life insurance policy. Now, this isn't insurance specifically for death. This is insurance designed for living. It's insurance designed for banking. It's issued by companies that have survived world wars, depressions, ups markets, down markets, financial crisis, pandemics. The cash value is guaranteed and steadily increasing, which means banks will lend against it, just like a home equity line of credit with your house. Only better. With an insurance-backed line of credit, the bank lends you money and your policy is the collateral. And then you have no margin calls, no forced liquidation, no panic selling. If the loan's never paid back, guess what? The death benefit will pay it back. And here's where the strategy has evolved. We don't just borrow to invest. We borrow to invest and to engineer cash flow. This is where Ysurance changes the game. We took the banking logic, leveraged life insurance, and institutional strategy, and we combined it with cash flowing data centers, Bitcoin mining, and tokenized yield strategies. Instead of hoping markets go up, we create cash flow. Instead of selling assets, we borrow against these stable ones. Instead of taxable income, we engineer tax-advantaged outcomes. Your dollar now stores value, creates leverage, generates income, protects downside, builds a legacy, and does it all at the same time. Now, tokenization adds speed and liquidity and efficiency. By having your capital in the Ysurance strategy, your capital isn't parked, it's actually working. And banks and insurance companies and family offices, they already do this. We've simply made it accessible to everyone. Once you understand this, you start looking at the places that you're putting money in a different way. You start asking the questions, Are there any guarantees? Can banks lend on it? Does it create leverage? Does it generate cash flow? Is it tax advantaged? Can I access it anytime? Does it leave a legacy? Well, if the answer to any of those questions is no, then it's probably not the kind of asset that's going to promote a legacy and income and growth and wealth for you. So if you want to explore how this could fit into your situation, just schedule a strategy session. This is no pressure. This is just a way to clarify and show you mathematically how this works. Because once you see how this system really works, you'll never play the old game again. So grab a link below, schedule a time that works for you. Look forward to talking to you then. Until next time, take care.